We go. Happy Saturday, everyone. Thank you very much for attending another session of RM Smart Investing, our weekly market analysis. I hope you're all doing wonderfully, and I'm so pleased to have you. So again, every week, what a week we had. It was like week of, in some ways, some of the things, a lot of events happened, but the markets kind of, besides the NASDAQ, really nothing kind of moved, but it was pretty eventful, especially on Friday. So, as always, we review the economy, the markets. We look at from the fundamental to technical side of things to the charts. I do have a few things in our emerging markets and a few more of an economic side on economy on the lesson of the week. I hope you enjoy that. Trade of the week. It was an interesting week last week. So, and then the screen of the week. So with that in mind, we dive in on economy. And last week, the big thing, obviously, it came toward the end of the week. On Friday, we had the non-farm payrolls, and basically the previous week with all the what is happening with the Fed, they were very much looking forward to see how the non-farm payroll will be. Now, it came much stronger than anticipated. It was interesting that, the previous week we had obviously the GDP numbers. They forewarned us, telling us that the economy has slowed down. We have a negative quarter, and yet the job market looked much stronger than anticipated. The numbers came at 520,000, and it was expected between 250 to 258,000. On top of that, they actually revised the July numbers. So basically, what is happening is now, after 29 months from COVID, we are back to pre-COVID numbers. So that's, which is amazing. So as we've spoken, the service sector is the one which is leading. Remember, during the COVID, we had the manufacturing or the retail side of the actual physical things, and now with opening of the economy, the service is on the move. We look at the education, health, leisure, especially hospitality. Look at the hotels, for instance, the restaurants, the professional and business services. Now, also the manufacturing payrolls also rose 30,000 in July, and this is the 15th consecutive monthly gain. Now, the unemployment, what happened, went to the low of the pre-COVID of 3.5%. The catalyst for that was the participation rate has come down. So what that means is, less people are looking for the jobs, and because of that, so the denominator has gotten smaller. So in that sense, that's why the numbers are actually shrinking. So basically, that was the 3.5% went from 3.6 to 3.5%, and versus June is a combination of 179,000 gains in civilian employment, and then we had also in 63,000 decline in the labor force. So basically, because of the small business startups, that now the dip in the labor force shows that the report was not 100% pure good news. So we gotta take these with a grain of salt. It was interesting how the markets reacted. The first thing on the market's mind is about the interest rates, about the Fed, about inflation, how the Fed is going to react. So a very good news became bad news, and last week bad news became good news. So that's how the markets look forward. So obviously, with this really good numbers, what happened was they thought is, well, we have strong employment. Now the Fed is going to have free hand, and they're going to, in September meeting, they're going to go ahead and increase it. It has taken 66% the chance that the Fed is going to increase it by 75 basis points. Now the thought is, we will discuss the upcoming week with the CPI numbers. If that's strong, then they could even go to 100 basis points. So that's how the market really reacted, but they had to digest it, and We'll discuss it more in our chart. So going back to this is another thing you want to pay attention is the average hourly earnings, which has rose, it rose 0.5% in July, and it is 5.2%. Now, but remember, the inflation is pretty high, and here's 8.8%, let's say in July versus a year ago. So in reality, the wages are not keeping up with inflation. Also, the total hours workforce was 0.4% in July and about 4.1%. And it goes back to the labor participation again. So what we have some important things coming up again next week, and that's where the market is looking forward to, especially Fed is looking at. And that one is on Wednesday. We have the CPI. So watch at 5:30 a.m. Again, those are times if you're up, they are market movers. So we want to watch CPI and the core CPI. And then following day, the Thursday, we have the PPI, which is the producer's price index versus the consumers. And then on Friday, we have the preliminary University of Michigan consumer sentiment, which is also, it's a good gauge about the consumer expectations, their behavior, what they are, again, are they positive about the future or they're not? So we will have a little more in-depth conversation about that. So this week, I just want to go back and look at, again, you can see that the actual numbers for the employment came at 528 versus 250. And then the average hourly were up 0.5, and as we discussed. So, and we will discuss the consumer credit came at 40 billion, which is positive and negative in some ways. So it was much higher than was expected at 24.7 billion. So as always, we want to look at the spread. So the spread, it generally foretells that if there is a recession ahead, when you see that the 2 years actually at 3.25 and 10 years at 2.83, so the 10-year has gone up the rate. So the spread is getting larger, and that's why you see this inverted curve, yield curve. And again, from technical point of view, that foretells the recession. So again, interest rate is the key component. It's always, we've been witnessing it for the last year or so. As far as the sentiment, you see the sentiment is kind of improving, but there's still the investors are on the on guard. So although the negativity is going down, the positivity is going up very gradually. And this is, you see the difference, still negative 8% bulls, bears versus bulls, and way below averages on both ends. And the same thing with CNN fear and greed. You can see we've had this huge, remember we had the extreme fear. Now, basically the improvement in the market since June 16, so the market is getting a little more comfortable. Also, just don't forget this is the summer doldrums too, so it's very event driven. And obviously last week that the whole news was about the Speaker of the House, Pelosi, visiting Taiwan. And you see how one thing can move the markets in a matter of minutes. I mean, it can go up, it can go down. So this is, in that sense, it's that, again, being in August, that's you have to take into consideration when you're doing your trades. So again, you see the sentiment has been improving. As you can see, the market has been improving. This is from June 16th, at the bottom about 36.40, 36.20. We are all the way back to 41. We hit 41.60 or so. So that's about 500 points. That's a pretty big move. But now we are hitting big resistance, as we will discuss. The same thing with Citigroup market sentiment. We are very much close to zero. It is in a neutral zone. So the week that we had, the Dow, you can see it was neutral. It was down 0.13%. S&P was also really neutral, 0.36%. Really, it was a nothing week in a sense. If you went on a trip and came back and said, oh, 1 week, nothing happened. but interim, as you know, there's a lot happened. The winner was the NASDAQ. They were up 2.15%. And if you go under the hood, in a sense, and look into the numbers, you see the big movers were Apple and Tesla and Amazon. So they're the ones, again, these big numbers from the big movements from those obviously large market cap stocks really moved the NASDAQ. And but as a whole, you can see that the total stock market was up 0.67%. If you look at again, see the large cap growth was 2%, as we discussed, versus the values stocks were actually down. And then when we look at the mid cap, actually 3.3% for growth and negative 1% for the value. And also the growth in small caps did the same thing. So that's the food for thought. As mentioned before, if we are in a recession, but with the strong employments, you never know. Economists have to really all agree, and usually it's after the facts. And generally, in a recession environment, the growth stocks actually do better than value. So just keep that in mind. Now, when we look at are we in a bear market, are we in correction market, you can see we are almost out of the correction in the Dow Jones, as we are down 10.86% from the high of January 4th. In S&P, we got out of the bear market. We are in the correction market at 13.58. But NASDAQ, we are right on the cusp. We are still in a bear market at 20%. Now, oil has been the news last week. And as you know, we will discuss it, that concern about the whole global slowdown on one hand, and then we will discuss a little bit about OPEC, how Saudi Arabia is snobbing, for instance, in some ways, the Western world. Marconi was there, President Biden had talked to them, but they're not really, they haven't been very helpful. As I mentioned, they are enjoying these moments. So, but oil has been down 28%. So, from the charts point of view, here we've been discussing as far as the Fibonacci numbers and also the moving averages. You can see how nicely we've been moving up. And we are in a somewhat of a resistance now. And although we are above our 8-day moving average, which is exponential, it has been a nice support since we broke out. We pay attention. As I had mentioned before, when we are in an ambush zone, as when we break out of the ambush zone and we break out of 61.8, it quickly goes to the the 78.2, and then it goes to the 100%, and we came very close. So the area of the 4162 is important area. We've been hitting our head, and the next area is going to the 100%, about 4,200, I would say, to 4211. So keep that in mind. Those numbers that they create a major resistance, and so we want to see, was this again a short covering, a bear market strong rally, or does this have legs? And this will, once this breaks that 4,200, then there's a good chance it can move up pretty quickly. So one thing also, this is again a Fibonacci lesson, and if you take a look at our Fibonacci class, for instance, you see the movement we had in March. I believe it was from here to here, is very much, it is called symmetry. It's very much symmetrical from the movement from here to there. So does that mean anything? Generally, market likes to do things in orderly way. So from the time, as far as the time and the price movement, these two are very symmetrical. So just another food for thought. So again, that 4160 to 4211, it's going to be critical. And then, of course, please pay attention to that CPI number, because that could be a market mover. Again, the market is still jittery, and you see the volume still is not, the volume hasn't been that high, because again, it's summertime. As far as looking at the Bollinger Bands, well, we've been, volatility has been expanding, but the MACD has been in a positive, stochastics are embedded. We have broken above that 100, but we are really hugging that. So, and you see my resistance at 41.64 from the past. So we've been really hitting head against that. As I can see, Bollinger Band is also here. So a crucial week this week from the CPI point of view. And the same thing when we look at the NASDAQ. NASDAQ was strong, again, because of the big cap stocks. And then, so it has been stronger, embedded, MACD is up. Our CCI is giving us a little heads up, so be aware of that. So whether we're getting a little divergence here or not. So be aware of that. NASDAQ, remember, Tesla had a big down day on Friday. It was kind of understandable with their 3-for-1 split coming. Usually they make a big run and then they split. So, I mean, they come down. So basically that was the same thing with Russell. We have broken above that 100-day moving average. Very similar. MACD is up, stochastic is up, but again, we had a little divergence in the CCI. So let's pay attention to that. CCI is pretty dynamic. And then as I mentioned, we were very flat to the down on Dow Jones. You see we've been hugging that 100-day moving average. Although we are embedded, the same story. You can see it from the indicators point of view, they're very similar. The same thing when we look at transportation, we talk about transportation is important for as far as the economy is concerned, and it's a leading indicator. So we see the same thing with the 100-day moving average has become a magnet. And again, embedded MACD is up and the same CCI story. So what is happening with VIX? VIX is, been struggling a lot, and that bodes well for the markets. Are we basically, are we in this situation basing? We are back and forth between oversold and embedded. MACD is down, the CCI is down. So right now the VIX is still not out of woods, so that's again good for the market. But VVIX has been really, look at this volatility band. The Bollinger Band has been really stabilizing. So what that tells us, as I've said it before, so the volatility of VIX is really narrowing, but it's ready to do something. You can see we haven't had the width like this in quite some time. So pay attention to that. All right. Well, the whole idea is about our yields, our interest rates, and the 10-year. And you can see we had a big move last week, and basically, again, there was a couple of things. You see the yield was going down, anticipating what's going to happen with in the situation, more of a political situation, with Speaker House Pelosi visiting Taiwan. So that the bonds became safe havens. So the money moved to 10-year note to the bonds. So the yield did go down. After the fact, when there was no really major things that mainland China did, then the markets were relieved, and they went on the same thing we shall see like with the gold. So the safe havens, all of a sudden, they were reversed and the yields went back up. And of course, on Friday, we've had a very strong job market. So the fear of what the Fed is going to do comes into the picture. And that's why we've had this big move on the yields. And you see what is happening now, that 18 was actually crossing the 100-day, which meant it could be sell-off, but the momentum is going up, MACD is crossing, so there is that concern with the yields. Now, I want to go back, we've discussed this many times, this goes back to 1980. We look at this is on a monthly basis, the 10-year yield, and I've said it for every couple of years, we've been discussing that the 2% and the 3% are major important numbers. And these are on monthly, although interim, we have moved above the 3, we've hit the 3.5%, but on monthly, you see we've never really crossed that 3%. So the markets, come close, we've done that, but we are in that zone. We hit the lowest in August, about a little over 0.5%. Here we are. See how big of a movement we've had, especially since January. So the question is, that 3% is important, and we haven't seen it in about 4 years or so. So let's watch that. We are 2.84, so we watch that, and this is the opposite. This is the 10-year notes, and again, the idea was we moved up because of the political tension, then big candle down on Tuesday, and then a big one Friday, and we are right in that support, although the 18 was crossing the 100. But the momentum is down. The MACD is exactly opposite of what the 10-year yield was showing us. And the same thing with the US, the 30-year bonds. It's very, very similar. So we want to watch this. So that CPI number, that Wednesday is an important day. As far as the financials, it was really interesting that obviously because of the yields going up was helpful financials. They didn't really move a lot though. You can see we've been really haven't done a lot. So you would expect with this reversal, they would go up more, but they did not. Although they're embedded, MACD is up. So, but it was not a huge move. Dollar is also, it's very important. And when we look at the dollar, obviously there's few things you have to take into the consideration. Obviously, the higher yields, it's helpful for the dollar, but then you have to think about higher yields. Is it helpful to NASDAQ? So NASDAQ had a nice, again, better week, but if the CPI numbers come, if the fear of higher yields come back, then that's going to affect companies in the technology. So be aware of that. So that's why we want to watch that. Now, the dollar, you can see, again, it was strong. We are against the 18-day moving average. And we see we went from embedded, actually, now momentum has moved up. MACD, the trend has been up. So but the momentum is also trying to change, and the CCI did cross its moving average, and it's above -100. So there is that strength. So with that, you have to think about strong dollar. Is it good for inflation or not? So it's good for us to have strong dollar, but you go globally, what will happen to the strong dollar? It will create obviously weaker currencies, whether it's euro or any type of emerging markets, especially with the commodities being really exchanged in dollar, priced in dollar. So with the stronger dollar, we are not going to get away from inflation. So that becomes a sword in itself, that imagine any country, let's say in Europe, if there is a recession there, but a little slow economy, and yet the dollar is strong. Again, if you have a weaker currency, that's an element of inflation. You have to spend more of your currency to buy a good. So this dollar is not very helpful. So that's why, again, the higher interest rate, stronger dollar, but stronger dollar, there's a higher inflation, and then we go, this keeps going. So higher inflation, then higher interest rate, then higher interest rate, higher dollar, and then higher dollar, higher. And so this, I hope you can relate everything together to see how everything goes hand in hand, and how the intermarkets, they work together. So we are in important things. Again, we want to watch that CPI, and everything is anticipating what the Fed is going to do. They are going to be speaking. So basically what we want to see is, what is the anticipation for September? So about 6 or 7 weeks from now, what they are going to do. And again, be aware that, again, with August, things can move very fast, as we could see last week, just from one event, political event. Gold, you could see that the gold has had a nice bounce from its support. But what happened on Friday? Strong economy, higher rates, not good for gold. On the other hand, obviously, inflation might be helpful, but that interest rates affected the gold. But also, gold was a benefactor of um, uh, that political pressure or political unknown about what is happening in Taiwan. So that also helped gold a little bit. So Thursday was a good day, but Friday was not so good. And the silver has had a nice move, but the silver was foretelling gold that things are not as good as it is. So basically, they've had some reversal, and they hit their Bollinger Band, as you can see, and they went down. Now we are in an overbought situation in silver, and copper has been very interesting. So it was basing and then just has had a nice strong move, and but we are close to that upper Bollinger Band, and we are overbought. Although MACD is up, but the momentum hasn't turned completely yet. And CCI, though, it is telling us trying to get stronger. So we will talk about actually the stock of the week, about the copper. Bitcoin, back and forth, regulations we've talked about. Look at this, I mean, the Bollinger Band, it is, again, that understanding of there hasn't been a catalyst to move it either way. But this is a long way where we were in November, for instance, around 68,000 or so. Crude oil has been the story. Again, slow economy around the globe that has really affected. There was political talks about OPEC and Saudi Arabia, but we are getting very close to the support that I've been speaking of. So we are touching the Bollinger Band. So we are oversold. So we shall see what happens this week. Also, you have to remember, it has been the seasonality. We talked about it. We reviewed in the lesson of the week what happens to crude oil, especially energy stocks. And you see in the summertime, the XLE had a drop. We had a nice week last week with the earnings from Chevron and Exxon, but we did hit that resistance, that 100-day moving average. We became overbought. We hit the Bollinger Band. And as we have said, once we hit that Bollinger Band in an overbought zone, we always like to go to the next support. In this situation was the 18-day moving average. And if we could not hold that and the momentum continued, then we will have to go to that next support, which will be the Bollinger Band, the lower edge. So that's where we are. Again, Friday was a good day. Again, strong economy. But as far as we are not out of the woods, but as I've said, it's more also with seasonality and energy. All right. Now, expected move. Last few weeks, we talked about how abnormal it was. We've been outside the expected move. Finally, you see this week really didn't do anything. So, and it was really interesting week because it's that one of the very few times, if you go back in all of these, that we did not hit any part of the edge, not upper edge or lower edge of our expected move. So that was an interesting observation. So I just thought to share that with you. Look, we're just right in the middle. NASDAQ, on the other hand, did hit the upper edge on Thursday, and then we closed right under the upper edge. So that was normal, made market makers happy. The same thing with the Russell. They were a little up. They did not hit their upper edge. And the same thing with the Dow. They were right in the middle, smack in the middle, and they went close to the lower edge. But yeah, the S&P was very interesting. By the way, S&P last week's expected move was like 80, 80.5, and this week is about 88, so something like that. And then the bonds hit the upper edge, then came close to the lower edge. Again, that was a Friday's news. Gold, actually Thursday had a very good day. I did have my gold trade and hit 3 out of 5. perhaps knowing that, you never know. That's why you always put your targets. Would have made sense to just get out of it. We are outside the expected move, knowing that the numbers not from payroll are coming. It was a 50-50 really, but that's okay. That's what you have, your targets. And so obviously 3 were winners, 2 were definitely losers because we had a big reversal in gold, as you could see. And then silver, the same thing. We closed right on the lower edge, and the financials were not much of a part, event. We closed right at the where we were on Friday, and it was the energy which really had a big sell-off, and we went all the way almost 2 standard deviation outside the expected move. All right. Emerging markets, let's talk about that. Rather than what happened last week, I thought let's take a look at the July's performance. We'd like to see the returns, but also the valuation, price to book versus with the 5-year average, and price earnings versus the 5-year average. So look at the different, again, we look at the large EMs, technology, global benchmarks, and then we go regional. So this is more of a reference for you, so you can see what the markets did. One thing to remember, again, internally, Russia, the markets are working, but as you know, there is no investments for the foreigners. So basically, Russia is down 100% in a sense, if you're a foreign investor. And Lebanon, Sri Lanka, Zimbabwe, and Argentina and Nigeria, because I remember we talked about the Forex and the FX, the exchange restrictions, there is no foreign capital coming in. So just remember that. So it was a very strong market, especially in the United States with the technology, the NASDAQ, they did very well. So you see the developed countries, the US tech, they did 11%, developed were up 8%. And the Gulf countries, they were up 6%. One of the things you want to pay attention to, small caps, again, in the technologies, they did very well, and US mega techs up 19%. On the other hand, the China's tech apps, they were down 13%. So this is why I want to pay attention. That largest EM, emerging markets, you look at like the BRICS, they're a tale of, the tale of 2 cities, in the sense, 2 markets. Number one, India was up 9%, and China was down 9%. And let's ignore that Russia was down 15% locally. Saudi Arabia was up 7%, Brazil was up 6%. So, but this is so not all emerging markets are the same. And then when we look at Asia, Singapore was the winner. Pakistan was the worst performer, down 17%. In Africa, Kenya was up 17%. And Zimbabwe, we talked about, really cannot invest in there, but locally they were down, they were the worst. And then in Europe, Ukraine was up 25% in because things are coming back. So they were up 25%, and Turkey was down 1%. Middle East, again, majority of companies, they did very well. And Latin America also, they did pretty good. Jamaica was down 3%, but Chile was up 12%, and Argentina down. And then these are the valuations you can see. So that's one. The second part I want to talk about, again, with the opening of economy, we talked about the service industry, we talked about tourism. Tourism is very important, especially in developing economies, and discussed it. So we want to combine what are some of the countries that the tourism plays a big role on their GDP, as well as we want to look at the valuation. So based on that, the farther we go to the right, that means a bigger chunk of their GDP comes from the tourism. So for instance, you see Thailand is almost over 10%. Jamaica is close to 11%. Croatia is over 11%. And Iceland is 12.5%. So basically, the tourism plays a major role in their economy. And you see Egypt, Sri Lanka, Jordan, Dubai. So it's about between 5 and 6%. Mexico is over 7%. So this is good. This is a positive things, but how about valuation? And the valuation, we're looking at the price to book versus their 5-year average. So this is a discount below 100. This is premium. And you see, like, for instance, Thailand, based on tourism coming back, they're doing well, but also they're pretty inexpensive compared to their valuation. Vietnam is valuation was as low, and you see there's like in Middle East, they're kind of richly valued. Tunisia, even Greece, very a little bit above its average. So just a food for thought. You can again, more information how different parts of the GDP play a role. The next one, we want to talk about the fintech, the financial tech, and also the digital payments. And we talked about banking last week, and we talked about, a lot of countries, they don't do banking, but the development of technology is really helping. The new generations are very familiar. So digital payment firms, I just want to give you some of the major names in different countries. So, from Saudi Arabia and Russia to South Africa and Vietnam. So these are some players in the digital payments. And basically why it is important, as I mentioned, especially with the younger generation, and especially with the traditional banking the way it is because the payments fintechs are focused on increasing transaction value. They're very much about the technology, the platform, the productivity, the innovations. And basically, they are not really focusing much on the credit defaults or the profitability or brand strength. So it's the ease of use, the customers value payment include. I will show you, they did a survey of about 56 companies, and they wanted to see what are some of the most important things for the consumers and what technology part of this fintech or the friendly digital payments and what were the success. And here we are, the executions, the approvals. And so these are the key values for the payments in fintechs, and you will see more and more. And that's why, again, that blockchain, the blockchain we've talked about, they are important. And that's why I think, again, the digital payments will stay with us. Switching, we talked about crude oil. So I wanted to show you there's something called the spare oil capacity. And what that means is, what is your total capacity and how much of an output you had? So that means how much is it spare? How much more you could have output if you wanted to. And as you can see, Iraq, other OPEC countries, Libya, they're really going almost to the maximum capacity. Iraq is their closest one. But then countries like Iran, Saudi Arabia, and United Arab Emirates, they still can do more. And that's why we talk about, like, say, Saudi Arabia or United Arab Emirates, they kind of snub, President Biden and President Rouhani in the sense that they do have the capacity to do this if they want to. So, but this is just a new word. I just want to be familiar with spare capacity. The other thing I want to show you that the foreign direct investment, which is a really blood of in frontier markets, developing markets, they need capital. You could have the greatest idea, but if you don't have the capital, that will not be developed. So basically, it is important. So they've been a really nice flow for 2019, 2020, and 2021. That's been 2021 really broke the record. So they've been really nice movement. But 2022, it's going to be a tough one with the higher inflation, with the Russia-Ukraine war, with the also slower economy. But 2021 was a really excellent year for the Africans. So I want to break this down. You can see in the Southern Africa, South Africa is by far the largest of all the African countries. So you see the East Africa gets the least amount, and but South Africa is #1 between South Africa and Mozambique. And then West Africa comes next with Nigeria and Ghana and Senegal, and then Central Africa is next. So just a food for thought, how these foreign direct investments work, a little familiarity with the African economies. This is more of a tidbit about generally the countries and how they are well received with the other countries. And one of the ways we can see the freedom gauge is how many countries they require visas if you're a citizen of the country. So Singapore has been for the longest time, it's 192 countries will accept you and they don't require you to have a visa. South Korea is the same thing. And then we move, and as you can see, the colors, you see Europeans, there's a lot of Europeans, and focusing more on the emerging and developing countries. But you see two Asian countries are more accepted than Germany, UK, and United States. And then we have Greece, Hungary, then you get into, but the bottom one is you see Iraq, Pakistan, Palestine, Bangladesh, Lebanon, Sri Lanka, and Iran. So these countries, you know, they need another 150 countries to get they have to get a visa in 150 countries, for instance. So just again, a little understanding how the acceptance are there. All right, so let's dive into the lessons, and it's going to be a little bit about the seasonality. I always like to show the seasonality, and then we're going to go a lot about economy. So this is from 1950 to present. We are in the month of August. We just started. Now, month of July did not disappoint. It was the strongest month since November of 2020. So this worked out well. Obviously, April was supposed to be the best, one of the best months, second best month, and that didn't, that fizzled out. But July did work out. August is not a very attractive month. It's very much low volume, event driven. And as you can see, September is the worst month coming up. And that's one of the reasons I think you hear, you know, they say sell in May and go away and come back in the end of October and start buying. So, but this is seasonality, just a tidbit. I want to share with you what is the average S&P per month. They've been up 0.7% per calendar month on average. The largest monthly loss we ever had was in 1987. I vividly remember that. I was part of that in October 1987. It was down 21.8%. And the best month since 1950 was in October of 1974, after the bear market ended in August. And basically it was up 16.1 from 16.3%. So let's go to economy. Again, we talked about GDP last week, and then we are looked at, you know, we had a very strong employment. And the question is there a correlation between a low employment and the recession? And what happens is, this is from the Fed, which is St. Louis Central, Bank, Federal Reserve, actually. So what we'll see, we notice that every time before any recessions, we've hit the low unemployment. These are all the recessions, recent recessions, and it goes all the way back to 1970s, and you see that basically they're a precursor and evidence of overheated economy. And inflation is not even the question now, is additional now, but it's not necessary symptom. So you can see this was before the the COVID, and obviously had the highest. It was dramatic what happened. We froze, but this is where we are. So I put a question mark. Is it necessary or not? But we still have a hot employment, but is it part of the precursor that we could have a recession. Of course, we had the two GDP numbers coming out, and but because we keep talking about employment, how hot it is. But the history tells us that yes, but then we are overheated, so we could have slowing. So just food for thought. The other question is the labor force participation rate. What has happened after the COVID? Basically, the high income pre-COVID, they almost back where they were as far as their participation goes. So, and not, I mean, they were at 88, now they're at 70. So they're getting close to that. This is the number I want to look at. The low income, on the other hand, is still lagging where they were before the COVID. And you can see the event that happened. So every time we ran out of things, they started coming back. And but the participation is not there. So till this comes back, we will have that labor shortage. The other thing, we talked about consumer credit, and this past weekend we saw that there was at 40.15 billion in June, and then it was up. The previous month was revised to 23.79, and basically what it is the consumer credit. Basically, it's the credit card, the student loans. It doesn't count the mortgages, and you see it was a big jump. So there's a lot of borrowing going on, and on an annual basis, consumer credit surged by 10.5%. So this is something you want to pay attention. What that means is that consumers are now relying more on borrowing again, and is what has happened to the savings rate, and are they depleting that? So basically, I just want to show you where we have been, and that was one thing we had last week. So that was kind of negative as far as if you're looking at student loans, and as I said, you exclude mortgages. The other thing is coming up this week. It's a preliminary, but what is the University of Michigan consumer expectation, which last month when we saw it was the lowest since 1980. It was at 47.3, which was shocking. There was no expectation. So I want to go back pre-1960s, and you can see that the lowest we've had was in 1978, 79, and 1980, and basically that's the lowest we've had, and then now we hit that. So just pay attention to these sentiments, because that's again the precursor of the consumer behavior. Are they going to go buy large items? They think they don't have that confidence. So that's important, and that's important for GDP. So basically what expectations are when we talk about it is that three areas. One is how consumers view prospects for their own financial situation. Then they look at the prospects to the general economy for near term and the long term. So those are the three things. They are questions, they're 54 questions. And based on that, the survey can say they're positive or negative. And they're really statistically done for all American households. Now, this is excluding those in Alaska and Hawaii. So just know how it's done. Again, it's a survey. So, and it's a minimum of 500 interviews are conducted by phone. The last but not least, this is completely out in the field. It's about consumer behavior again. It's you want to invest in beer company, that will be something. But it was interesting how beer drinking habits have changed since COVID. So in Spain, they are actually going out of home 83% compared to 85, and they're staying at home a little more. And the behavior continues in all other countries, even more so. UK went from 72 to 63 going out, and they rather stay home. So how we can take advantage of this is, again, it's the marketing of, let's say, beer companies. Are they, and also the profitability of bars and restaurants and other things. So would they focus on, you know, the household consumers rather than businesses? But anyway, it was just an interesting behavior from the markets. All right, so let's talk about the trade of the week. Trade of the week was very simple. We had our non-farm payroll on Friday, and this was unbelievable for, as I've said, so this is a trade that you can actually do it on a futures market, or at least create your boundaries, whether you want to do condors, whether you want to have the low or high of the day. Basically, what it says, again, in the review, this was the numbers came on non-farm payroll. This is a 5-minute candle, and generally 80-85% of the time, the low or high of that day markets is in that 5-minute candle. So this was the high of that candle. This was the low. We broke through that, and then we just float around it, and then we never went above. And so that was your high of the day, basically. And we just float right in the middle. So that was a NFP trade. The other thing is, this is the reason the bond market, this is a 2-minute chart. This is a 2-minute bar on a 10-year note, is huge. And of course, it dropped, and that area, even the low of that bar, became the high of the day, and then we floated around. So this was really good trade if you were playing that. So we usually have a trade. So once we broke this area, that was a good short. But how about the whole week? And if we go back, there was quite a few times, again, on Friday we closed our gap, and then we went down again. On Tuesday, we closed our gap. On Monday, we closed our gap. We came close to half a gap closing that Wednesdays. Interesting was Tuesday. If you were watching the bond market was going up nicely, and then but then Speaker House Pelosi landed. Nothing happened. The plane didn't crash or anything, and the bond market just collapsed. They hit their highs, and then they just continue going down. So again, you can see how the political events, the dollar, interest rate, inflation, all of them go hand in hand and affect the markets. So the last but not least is I just thought share. I had this it just caught my eye. This is a mining basic material. It's a Canadian company. It's the Teck Resources. Had a nice Friday, broke out. So I was looking at, we have higher lows, as you can see, and now we decided this zigzag is higher highs. So let's see if there will be some good opportunities on this, at least to this, the moving averages, the 50 and 200. You see you're down 10% from both of them, but we have broken above the 20. So I thought just from the charts point of view, but also valuation, it's at 3012. The Guru Focus gives a value of 3784. It has a good profitability. Financial strength, its culprit is the growth. It doesn't have as much of the growth ranking at 5, but it has a good value. So just want to look at it. There in a coal and copper business, and headquartered in Vancouver, British Columbia. As you can see from the valuation, whether it's the book value, the free cash flow we have talked about, price to sales, the grand numbers, some good value. So that's in the long term, you can take a look at it. On the short term, you see we had a squeeze, and the squeeze fired long. right around here. So, and the A wave has been positive, but the C wave is still negative, but the colors changed. This is a 16 minutes. You see in the Hakinashi, the color changed, and MACD also crossed on 16 minutes. So for short term, we can play maybe this. Long term, we can use the valuation. So that was just a food for thought. The last but not least is our squeeze play. I want to spend a little time on this, just explaining. Again, we just saw how the squeeze was fired, and basically these are the small cap 600. So you want to pay attention from the setup. These are the colors, but this are the technical side, is a fundamental side. You see, we rank them with this. They're green, and when they're both green, that gives you or something like this, they give you some good candidates to look at. And this is the relative strength. You see, for instance, in this situation, Lanthos holding is it's like a 99.66. So that tells you that compared to the market, they've done very well. They were up 10% on Friday. For the month, they're up 15. For the 3 months, up 22%. And then for the 6 months, they're over 105%. Then you also see their PE ratio. So maybe you can combine valuation with their, maybe technical side, for instance, see if there's really been beaten up, but they have good valuation. Large, the small caps, but they still have good market cap, 2.3, almost 3 billion. And it's respectable. I don't like it under 500,000, but it's still under 69. So you want to have a good volume. So this is how you can look at it. So basically narrow things down. So I just want to just throw this at you so you can maybe on weekends have a little time, do some research on those. The last but not least is, earnings continue. So we haven't stopped yet. The big ones are coming next week. Is going to be this Disney. Everybody's looking at that. So we see some entertainment between Six Flags and Disney, and Hilton Grand and services. And also we have Tyson Foods. So pay attention to that. With that in mind, I hope it was helpful. I hope you are prepared for next week, at least get some good ideas. And what I'm going to do, I'm going to stop our recording and open up for